The Reserve Bank anticipates that the economy will grow at 1% in 2017, down from an earlier forecast of 1.2%. The bank is worried about the sovereign credit rating downgrades and weak business and consumer confidence. Governor Letsitsa Kganyago said the MPC remains of the view that we are likely at the end of the tightening cycle. He said a reduction in rates would be possible should inflation continue on a downward trajectory.
Mining and agriculture are providing us with an uplift at the moment, but the underlying performance of this economy, retail, manufacturing and financial activity, is especially weak, and it looks and it feels like it's getting weaker. And when I think the Reserve Bank sees that data, it's forced to revise down its growth estimates. It didn't revise them down that dramatically, but if you look over a period of time now, we've moved those growth rates systematically lower, where we don't expect this economy to go back to 2% growth over the next 3 years. That is not a good outcome given the social dynamic in this country.
Annual headline consumer inflation slowed to 5.3% in April from 6.1% in March. This is attributed to food prices increases, which slowed significantly as the effects of the drought dissipate. Economists expect inflation to increase going forward on the back of higher fuel prices before slowing on softer food prices. Inflation is expected to average 5.6% this year. Stats SA also released the Producer Price Index, which slowed more than was expected to 4.6% in April from 5.2% in March. Producer inflation is expected to remain subdued going forward, but economists say the biggest upside risk to the producer inflation outlook is the volatile rand. The rand was trading at 12.88 against the dollar, stronger than the 12.94 yesterday. Analysts say the currency retained its 2 to 3% improvement built up earlier this week as the market continues to price a premium on hope for positive developments from this weekend's ANC-NEC meeting. The Bank South Africa Disposable Salaries Index, released this week, shows the take-home pay of South Africans increased faster than the inflation rate in April. This is due to higher inflation rate of the past year, on which current salary increases are based. Disposable salary increases will likely to lead to sales growth with improved consumer spending, mostly in non-durable goods, as confidence levels are still low. Gloria Sefakomosi, SABC News, Johannesburg.